Part 2 of interactive study of Mark Douglas's How to Think Like a Professional Trader. Hit like and subscribe, and let's get into it.
Are you with me on this?
Yeah, I'm understanding.
Okay. So I wasn't looking at like I said, paper losses. The money was out of my account, so I'd had enough. I couldn't take it anymore. So when you think about it in that
Coming
context,
off the back of talking about
when
his
you just
silver
made up your
trade
mind that I just can't deal with this anymore, it doesn't even occur to you to get out in stages. Why would I get out in stages when I've already gone through a week and a half of this back and forth, and and it's virtually wiped out my account? Because by then I probably would have had to put more money, even for me to take just one contract off and leave one on, I probably would have had to put more money in the account. And there just wasn't any point in doing that. Are you with me on this?
I don't trade commodities. I trade other things,
but the concept's the same.
Except it doesn't come out of my. It's, as you said, it's a paper trade.
Yeah, you already own. You own stock. You own an asset.
I don't know.
And if you want to hold on to that asset until it goes down to zero, that's fine. Okay, your money is not flowing. In a sense, money's flowing out of your account, but not in the same way it is with a commodity.
No.
Okay, I have to pay that money right now. You're just losing the value of an asset. I actually have to pay that money, and it comes out every single day. Go ahead. Go ahead and hand the microphone back to that gentleman.
Another thing that can be of interest here is, at least from the way I gathered you was talking a while ago, you really weren't controlling this. Your broker was doing this.
Correct.
So even if you had wanted to get out in stages, your broker was doing it, saying, hey, here's what I'm doing to you in this case.
Yeah, pretty much. Yeah, it's like I wasn't really in control of the situation because I didn't know what I was doing. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade. A monster trade.
Yeah, I got it.
And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000 on just 2 contracts. $400,000. And so, like I said, when I first started telling you this, this really had a profound impact on me. It really did. And I thought to myself, and at the time, I was managing a commercial casualty insurance agency in the suburbs of Detroit. Not really, I thought that's what I wanted to do. I didn't really know what I wanted to do, but, I aspired to management. I was very successful. And, at the time, even back then in the late 70s, early 80s, was making a 6-figure income, and I was only in my early 30s. So, I really had a lot of things going for me. But, after this experience, I thought to myself, I got to figure out what's going on here. And I certainly wasn't going to be able to do it in Michigan. So I thought, you know what? I'm going to Chicago. And that's what I did. I went to Chicago. I just thought, if I'm going to get into the business, who am I going to get into the business with?
Crazy.
Well, back then there was Merrill Lynch, there's Dean Witter, Smith Barney, and I thought, who are you going to pick? You pick Merrill Lynch, right? Okay, so I went over to the Chicago Board of Trade. They have an office right there, and right on the second floor of the Chicago Board of Trade. And they just so happened they had 3 openings for trainee brokers, and they had over 1,000 people applying for it. So how am I gonna be one of those 3 people? I thought, well, you know what? I went back home. I went to one of the bigger Merrill Lynch offices in the Detroit area, and I went through the whole employment process to familiarize myself with what it is that they required to get a job. And this is what I think got me that job at the Board of Trade, is that they had an aptitude test, and there's a multi-page application, but on the back of the application they had a square like this, and they wanted spontaneously, while you're filling this application out, spontaneously what they wanted you to do was to write like a little mini essay about some philosophical question. Before I went to the Board of Trade and actually filled out that application, I spent 2 weeks agonizing over every word, just to make sure every word of that 2 or 3 paragraphs that I wrote down was completely perfect. So then when I took the app, I wrote down exactly what I'd worked on. And I can imagine why they hired me, because if he thought that I wrote that spontaneously in the moment, thought, hey, this guy, we got to have this guy here. We got to have this guy. Okay, so I did. I got the job. Now think about this. Now, when I was working for the agency, the casualty agency, commercial casualty insurance, as a matter of fact, I just signed a contract not more than like 3 or 4 months before I actually went to work in Chicago, over a 3-year period for $360,000. And what Merrill Lynch was offering me was $20,000 on a draw. Okay. In other words, it was a, they're going to give me $20,000, but it's a draw. I mean, I got to pay it back based on commissions. Now, if you can imagine, there wasn't one person in my life, not one person, who thought that I wasn't absolutely stark raving out of my mind to give that up, to go to Chicago to do this. So, it wasn't like I had a lot of support.
He went to become a broker.
And it wasn't like I wasn't catching a lot of grief from everybody that I knew about what it was that I was doing.
Right.
So you can imagine my horror, is a good word for it. I mean, because when I got to Chicago, I'm thinking, why am I even doing this? I'm doing this because I'm going to Chicago because that's where the traders are. That's where the people are who know what they're doing. Correct? And then to get there to find out that is not the case. That is not the case at all. That there were 40, almost 50 brokers in the office, and none of them knew how to trade.
Right. They're not traders.
Not only did they not know how to trade,
I mean, share fillers.
Merrill Lynch made absolutely no bones about the fact that we were not traders. They spent no money, no time, and completely discouraged us from even learning how to trade. We were salesmen.
Right. Yeah.
We were taught how to talk about trading.
That's like every talking head on CNBC and any news.
We were taught how to, it's called dialing for dollars, to get on the phone and get people to open up accounts.
Talking heads still exist to create liquidity
and
like
even though this was unspoken, I'd say the underlying philosophy behind the business was, especially in the commodities business, I'm not talking about the equities. I'm not saying that on the equity side of the business that it wasn't more reputable, but this was about as irreputable as it could be. Because the underlying philosophy that we operated from was all commodity traders are terminal, meaning like they have a terminal illness. It's only a matter of time before they want to say all commodity traders are terminal, and it is our job as a broker to make them as comfortable as possible until they expire. In other words, to extract as much money out of their account as you could until they're gone. And even to this day, it just blows me away to think that when I went to a 30-day training class in Manhattan, and there were brokers from all over the world, probably about 80 or 90 of us, and the guy and the person that was the head of Merrill Lynch Commodities at the time, his name was John Conheeney, and when he came in to address our class, and to this day I don't know why he did this, but he said hi, and he started out with these words: the average Merrill Lynch customer loses all their money in 6 months. And that was the truth. Commodities, not equities, commodities. And that was the truth. That was about what it was. It took about 6 months for people to lose their account.
Just want your money.
And you just, like I said, you just go to the next one. So here I left this 6-figure income to go to Chicago to learn about this business and this industry, and here I'm in a situation, and it's like, it was, like I said, it was appalling, absolutely appalling. So I thought, well, okay, I'll make friends with people on the floor. They must know what they're doing. The floor traders know what they're doing. Well, I found out that wasn't necessarily the case either. Now, it doesn't mean that the floor traders didn't know how to make money. But and this is, I'm not going to get into this because we don't have time. But even though what you do is called trading, and what they do, they call trading, the way and the mindset that you have to make money couldn't be further apart, even though they're both called trading. The typical local, the person who traded for their own account in the pit or on the floor of the exchange, the way they made money, weren't trying to make direction-related decisions. In other words, it wasn't the kind of trading where they would find themselves in winning trades that were going in their favor, but that's not the reason why they put the trade on. And like I said, I'm not going to get into the specifics or dynamics of it because it'd take me too long to explain, and it just isn't necessary for right now. All I'm saying is that it's a completely, as a matter of fact, before I left Chicago and moved to to Arizona, the Chicago Mercantile Exchange asked me, and I worked on it for a while, for about 6 months before I left, asked me to put together a program to help floor traders make the transition from the floor to screen-based trading, because it's a huge psychological leap. It really is. It's a huge transition that has to be made. So what I'm saying is that, not knowing that before I got to Chicago, it was like, here I'm in a situation where I really didn't know anybody who really knew how to trade, or at least knew how to trade in the sense of creating that consistency that we're looking for. It doesn't mean that people couldn't make money. People were making money all the time. It's just that, what's the point of making money if you're susceptible to giving it all back? In other words, if this is your equity curve, and then all of a sudden you're
what does that look like?
Experiencing these huge losses and huge drawdowns. Not only is this certainly damaging financially, but it's also damaging emotionally. And it can be very difficult to recover from.
I'm all right. I'm recovering. I'm up $500.
These are what
month.
I call the boom and busters. Okay, you basically had traders that fall into 3 categories as far as equity curve is concerned. You've got your consistent winners, the people who have the traders. You've got your consistent winners. Now, it doesn't mean that there aren't drawdowns here, okay? But what do you think these drawdowns would be a reflection of for the consistent winners? Consistent winners take losing trades all the time. But their drawdowns are a reflection of what?
It's important to write consistent.
Anybody got any ideas?
Traders take
Money management.
Yeah, money management skills.
I talk about that all the time in my own videos.
Capital preservation.
It's important to write down.
These are 2 good answers, but not the answer I'm looking for. Their drawdowns are simply a reflection of the normal losses that any trading methodology will incur. There is such a thing as normal losses.
I learned this.
You don't have to
from
write
Mark
this down,
Douglas
because we're just starting to scratch the surface. We are going to go into this in far more detail later on.
A lot of what I talk about.
I mean, if you guys
comes
want to
from
write it
this
down,
guy,
that's fine,
comes
but
from
it
the book.
really isn't
I
necessary.
read from this guy. That's why I'm so
Okay?
into this
Normal losses
series. Hopefully you all are
that
too.
any trading methodology will incur. Then you've got people who learn something about how to trade, who acquire a good methodology where it is possible, based on that methodology, to experience a consistent income, but your equity curve might look more like this.
So break your rules.
Most people who are experienced the boom and bust cycles, these are the bust cycles, would say that something happened in the market to cause this.
That's what I said.
What you're going to find out today is that it is not the case.
Oh, Mark Douglas is going to.
Even though it may seem like it, it is not the case.
Oh, I'm about to get called out. I'm going to
These
get
are
called out.
virtually always the result of trading errors, what I call trading errors, which we're going to go into in detail later on.
I think my system had an error in it, in that it got caught in trends. I think it was a systematic error.
Just for the few people back here that don't have any idea of my background, I'm going to go a little bit further in it, and I'm just going to jump ahead for a second. I ended up being a trading coach, and working with. I was a trading coach for probably about 17 years. I don't really do it much anymore. I just pretty much focus on my own trading, but while I was, especially in the throughout the 80s and most of the 90s, I worked with a lot of floor traders, and we talk about boom and bust. There was one of the floor traders I worked with was probably one of the 5 biggest bond traders at the Chicago Board of Trade, and when I met him was in around May of 1992. And from January of 92 until the time that I met him in May of 1992, he had around, this is a guy that just traded for himself. He didn't trade for a firm. He just traded his own account on the floor of the Chicago Board of Trade in the bond pit. He had $12 million roll in and out of his account. And he had a particularly bad day, and he ran into somebody who attended one of my workshops and said, hey, you should go see this guy. He called me. We had a few appointments, didn't really go anywhere. And the next thing, about a month later, I get a frantic call from his wife, who I hadn't even met, didn't even know who she was. Got a frantic call from his wife that said, they're going to lose their house if I don't do something with him, okay? he had another real bad day. So anyway, I started working with him in July of 1992. And from July of 1992 until the end of the year, he ended up the year with almost $6 million. Now, that may not seem like a lot considering he had these swings, but he'd never finished a year with more than, I think, around $650,000 or $700,000. So he had just under $6 million. And so then he went on vacation. He happened to take a book with him called The Coming Collapse of the Bond Market. And this would have been in like late December of 1992, early January of 93. And came back. Now, if anybody remembers the bond market back then, it rallied to spectacular heights. But in the meantime, he'd read this, The Coming Collapse of the Bond Market, so he was going into the market every day short, okay? And pissing away this $6 million until he got to the point where he had about 2 of it left.
Don't believe what you read.
And took him about, I don't know, until maybe mid-February. And he was so exasperated that he said, hey, you know what? I'm willing to do anything.
Listen to the charts, not
okay,
what
now
you read.
Keep in mind, I'm willing to do anything. And it wasn't lip service. It was real. It was genuine. It was sincere. And I said, if you're willing to do anything, then here's what you have to do. What I've been working with him, what I noticed is that he was able to stay focused really for not more than about an hour a day. Now, this guy loved trading. I mean, he just loved being in the pit. He just loved every part of it. He just had the hardest time tearing himself away. But if he really wanted to make consistent money, then I felt that an hour a day was about it. Because after an hour a day, his focus would start to diminish.
This is why you journal your trades.
And then he'd also start to get reckless.
You start to see things
He's
like
the kind
this
of guy,
about yourself in your journal.
Here again, this
I'm
even
profitable in the first hour,
this
but
is
I'm
very
losing
difficult
money
for people to comprehend, but it's the absolute truth.
Let me stop trading after that.
He was the kind of guy where
Journal
when I was
your
working
trades.
with him during that period, in the second half of 1992, where he would have a $500,000 day winnings. He'd make $500,000, but when he called after he was out of the pit to have his consultation, he'd be real angry with himself because up to about 5 minutes before the close, he was up $500,000, and then he'd piss away about 175 of it. So it only ended up with $325,000 for the day. Now, this is just like a normal guy like us here in this room with $325,000, and this was not an abnormal day, but he's real angry with himself because he pissed away that 175. And then the next day, he'd do about the same thing. He'd make 400 and piss away maybe 2 at the close. And then the next day, he'd make, 350 and then piss away another 150. He's got spectacular wins up until Friday. But this accumulated anger that he was building up throughout the week, Monday, Tuesday, Wednesday, Thursday, by the time Friday rolled around, he'd lose $1.5 million. And then start the cycle all over again.
Gotta have a clean slate. Each trade you take, clean slate.
So
of emotion.
So now it's like I'm saying, you know what? Especially as a floor trader. As a floor trader, you really have to be focused. When you're trading at the level that he traded at, where you're trading hundreds, if sometimes thousands of contracts, if anybody knows anything about the bond market, we know that one incremental price change in a bond contract is $31.25, okay? You guys with me on this? So this would be a tick. So in other words, if the bonds went one tick up,
who the hell trades
and
bonds?
you're long one contract, you'd make $31.25. If it went down one tick and you were long one contract, you just lost $31.25. He would trade 1,000 contracts at a time. That means one incremental tick price change was $31,000. $31,250. Now, if anybody's ever watched the bonds move, you know that it can move 5, 10, 15 ticks like that. Not only that, there can be what's called price vacuums. Everybody familiar with a price vacuum? You know what I mean by price vacuum? It means that if the bonds are at let's say 106.10. You guys are probably not familiar with bond prices. 106.10. That was the last posted price. That something can happen, and you're long. Something can happen where there are no more offers, and the next posted price is 106 even. That means the market went down 10 ticks without there being any trades between 10 and even. No trades at all.
That was going to be my guess.
Which means if you're long, you just lost in that instant $31,000.25 on 1,000 contracts. This is quite common. So you really have to be focused. It would be like when you're trading at this level, I would make an analogy. It's almost like there's a couple of analogies. One, it's like if you're in an NBA playoff, it's the finals, it's the last game, 7 games, it's 7-game NBA finals, 1 minute left, the score is tied.
We're at 20 minutes.
The coach is going to send somebody in who's really focused.
Got to get to some more substance.
If the coach thinks you're distracted and you're not on your game,
type stuff.
You think you're going to get in that game? This is the way to be in these kind of circumstances in the pit. That's the kind of mindset that you had to maintain. Because even if you were distracted and turned away, there could be bids and offers that would have gotten you out of your trade that all of a sudden dry up. Meaning when guys are bidding and offering in the pit, they're using hand signals and they're telling you they want to buy or they want to sell and how many. And there's hundreds of guys all around screaming. Now these bids and offers can dry up because when you make eye contact and you point, you say, okay, we've got a trade. And
I found myself, can I pull up a real life example real quick? I found myself today, I took this trade today at the end of the day. Well, not within like the last 2 hours. I was walking around with my kid. I was carrying him around. So I wasn't really focused on this trade. So I just got out here, basically break even. I mean, I made like one tick in this chart, 1 penny. I'm talking ticks, talking bonds like he is now. Made like 1 penny in this trade because I wasn't really focused, so I just got out of it on a pullback. But if I would have been focused, would have held, I would have made 40 cents in this trade instead of 1 cent because this is where I was supposed to get out at 391.8. So that's maybe an example.
Then
of not
you
being
write your trade
focused
down on your trading card, and now it's an electronic handheld device. But otherwise, you make a trade, and then you could be out of your trade and take your profits. When these kind of things happen, these price vacuums, you could be in bad shape, and just be a matter of just a momentary look away. The guy that you were going to use to get out of your trade is gone now. He put his hands down. I'm in trouble. Well, what I found is that he could maintain an ideal mindset for about an hour a day. And so that's what I said. If you're really sincere, if you really want to do anything, you can only trade an hour.
People talk about everybody being different trading.
And he agreed to it.
Some people can
and he
only
said, "What
focus an hour a day."
I said, "It really won't matter." And it really didn't. He was
like
convinced initially that what hour he went in would make a big difference. It really didn't make any difference at all. He was so good. As a matter of fact, there were other bond traders that I worked with that said that watching him trade would have been the equivalent of like watching Michael Jordan play basketball. He was that good. And so he did. He went in just 1 hour a day, and because he knew that he only had that 1 hour, he was really focused, and he was averaging $175,000 for that one day, or for that on an average for that 1 hour per day.
That's pretty good, huh?
Okay, but that would be an example. He would be an example of an extreme boom and buster. Ever have that concept down in their brain about boom and busters, okay? And then what you have is you have the consistent losers. People whose equity curve looks like that.
It's hard to be a consistent loser.
Just to get back to...
If you're just following rules, no matter what the hell they are, you're probably going to be at least break
like I said, when I went to Chicago, I'm thinking, okay,
the stock market's going to work out.
I've got quite a bit of money. I sold my interest in the agency.
Money in the market.
But at the same time, I had a
Or maybe you just don't have rules. That's probably most
pretty
consistent
expensive
losers.
lifestyle.
They just don't have
as you
rules.
can quite imagine. I had a house in Michigan that I had a girlfriend, a very high maintenance girlfriend, and her two daughters were living in. And I had a very expensive apartment in Chicago and a Porsche, and I had the life, okay? And I was going back and forth every weekend to visit them. So I mean, really, my situation was, I couldn't maintain that kind of lifestyle with the money that I had without being successful as a trader. And that was the whole idea anyway. I thought, okay, I'll make whatever shortfall that I end up with as a trader.
That's
and
scary.
interestingly enough, I had to have my trading account with another brokerage firm secretly.
Wouldn't recommend.
I couldn't trade through Merrill Lynch. And there wasn't anybody else in the office who traded their own money. I was the only, unless they were doing it secretly and didn't tell me. I was the only person in the office who was actually trading their own money.
They probably all were.
Who actually traded, period, other than putting on trades for their customers. So what ended up happening is that, and another part of this is that I also had this, I can't really tell you why I knew this, it's just that I did. It just made sense to me. It just never occurred to me that trading was anything other than about psychology. I mean, the first trading book I ever bought was actually the very first book on trading, the first book that was devoted specifically to trading psychology, which was Jake Bernstein's Investor's Quotient, that came out in 1980. And there weren't that many trading books even available back then. And that was the first trading book that I didn't buy a book on technical analysis. I bought a book on trading psychology.
Trading psychology is what matters.
Not only immersed in the concepts of trading psychology virtually right from the very beginning, I was also keeping very extensive journals of my thinking process, what was going on, what I was observing from other brokers.
I've heard people talk about this before, like journal
in
your
the Merrill Lynch office,
also, not
as
just
well
your
as
trades.
what I was
I've never
observing
done that,
from
and maybe I
interacting with
should.
my customers.
Maybe I should.
And I noticed we were all kind of conforming to the same patterns, the same problems. But just say that because I did have this kind of foundation, to understand that it was basically psychological in nature. Because one of the things we're going to talk about, when I get into the skills section of the presentation, is that when you look at trading skills, it's like, well, what kind of skills are we talking about? If we're talking about thinking like a professional, we're implying that the skills are all mental in nature, and they are. Because when you really get right down to it and you really start to think about it, what physical skills are necessary to trade?
Muscles.
We're not talking about a golf swing or a tennis racket or any other kind of physical endeavor that we're familiar with. What kind of skills what does it take physically to put on a trade?
Bear down.
A mouse click, that's it.
It was like half empty.
Your
when we
ability to
started.
move the mouse and click it on the buy or sell button. It's that simple.
We're almost 30 minutes in, but I want him to I want to get to some substance.
And as a result of it being that simple, it's easy to think that, oh my God, trading is so easy. It isn't. As you well probably know, whether you've been at it a long time or even a little bit of time. There are some very sophisticated psychological skills that you have to acquire to get this kind of an equity curve. And virtually all these skills are founded in learning how to trade without fear. That's basically what this whole workshop's about, is learning how to trade without fear. Because that's what's going to screw you up on virtually everything. Everything that you can do wrong as a trader is going to be the result of what you're afraid of. And the effects that fear has on your perception of market information. So with my situation, it's like here I'd given all this up to go to Chicago, to learn how to trade, to find out that the only people who really knew how to trade back then were people that I didn't have access to. Meaning there were some big names in the industry who never really took the time or expended the effort to find out exactly what it is that allowed them to create a consistently rising equity curve. What they would say is, well, yeah, you got to go with the flow. The trend is your friend. Cut your losses, let your profits run. You know, there's all these neat little phrases, but
All
it's
the
like, who in the
buzzwords.
hell knew what that meant?
Who the hell know what that meant? All the buzzwords. That's a great place to end. He went over the 3 equity curves, got some talk about psychological skills, talking about how semi-worthless buzzwords are there at the end. But that's the end of part 2. Quickly, consistent traders take losing trades all the time. You must be focused all the time, and very significant psychological skills are needed to achieve a positive equity curve, and most of those skills revolve around trading without fear. So that's part 2 of the seminar. We are now 50 minutes into this 5.5-hour long presentation. Hopefully you guys are enjoying it. Hit like if you are, hit subscribe to don't miss other episodes, and you all have a good night.